Hey, what's going on, y'all? Steve Peterson with Infinity Investments. And today's video, we're going to be talking about the 3 ways of generating passive income in a distressed commercial real estate market. Yes, I said distressed. Now, here it is, August, what is today? August 7th, August 7th, 2020. Had to think about that. Smack dab in the pandemic. And as things prolong progress in this pandemic, we're seeing some shifts. Now, residential real estate in the Bay Area is continuing to roll somehow. And that has to do with the demand that we have in the Bay, also the very low interest rates that are out there, the monetary policy, so forth. However, that is not necessarily the case for the commercial real estate market, particularly in the retail space, in the hospitality space, and yes, in the office space. Now, every building is different. So let me just preface it with that. Wednesday was my anniversary. Went out to South Shore Mall in Alameda. And I was surprised how many people were out and about shopping on a Wednesday and how pretty much all the stores were full, open, and the parking lot was full at least. That was very surprising to me because in Alameda County, we have pretty much the strictest social distancing and, quarantine laws, if you will. Yet and still, that shopping center was bustling. So every neighborhood, every property is unique, you guys. But in general, there is some stress and soon to come de-stress in the commercial real estate market, particularly in the world of hospitality, retail, and office. So what do we do? Right? And if you're an investor, this could be a great opportunity, but you also have to be very cautious and have the right approach and right strategy, right? And so there's 3 ways that I wanted to bring to your attention about how you might be able to generate passive income in this coming distressed commercial real estate market. Number 1 is repurposing properties. Now, that means, let's say, for instance, taking a hotel building that might be vacant or distressed and converting it into apartment buildings, right? Or let's say taking a vacant or retail shopping center, turning it into medical office, right? Taking an office building, converting it into apartments, which could be done, has been done before. But essentially, taking a building that is in distress because the use is either no longer in demand or due to the pandemic, there's been a major shift in that industry. So there's been significant vacancies. The owner may be losing the property or just be ready to move on. And now you come along and acquire the property. But you realize that the highest and best use is not the current use. So you have to then repurpose it. Now, this has been really, really popular across all urban markets across the country in the past, especially in the early 2000s, where particularly folks would take warehouse buildings and convert them into lofts. Here in Oakland and in the Bay Area, that was a huge thing, but it wasn't just here. It was all really across the country in urban markets. And that became really, really popular. Now, industrial properties are doing actually very well, and the demand is really strong, especially with online, online shopping, logistics demand in California, the cannabis industry. So industrial properties are really strong. I mean, people are wanting to keep them industrial. But what I see as a huge opportunity, you guys, is taking properties that are vacant and distressed and converting them to where the demand is. And housing, for instance, is always in demand. And in the Bay Area, there's an extreme demand, right? And the rental laws are tough. It's tough to be a landlord and all that. But at the end of the day, housing is in demand. So if you could take a retail property and convert it into housing, or you take a retail property and convert it to like medical office. I think medical office is going to continue to be in demand. And within office, a lot of tenants are essential. Their businesses are essential, and they may be able to continue. That's why I say this is really a property by property, city by city, neighborhood by neighborhood thing. Not all buildings are in distress, which is very interesting. But that requires you, the investor who's out there looking for opportunities, you really got to think through this. This is not like a vanilla box cookie cutter way right now. I think you really got to be creative, and I think the best problem solvers will win. But you know what? That's kind of the case throughout all the markets, throughout history and business. The problem, he or she who can solve the problems the most efficient, the smoothest, is going to win. So number one, I think you need to focus on repurposing properties as a great way of generating passive income. Number two, okay, and this is really a unique thing. It's not new. It's been done for ages, but I think this is a huge opportunity. It's in the sale leaseback world, okay, for companies that own their properties, right? As we know, a lot of companies will be downsizing. A lot of companies will be doing more things virtually, okay? A lot of companies are in lease situations. However, there's a lot of companies that own their properties, right? They got a lot of equity in them, especially if they bought them in the last 5-10 years, right? And so as they pivot in this new economy, they may be saying, hey, I don't need all this space, you know, but we have a ton of equity in our property. Maybe we can sell the building, but we still need a place to operate. So as you, as an investor, you may be able to come and acquire that building, right? And then negotiate a long-term lease back to now the old owner who is now a tenant. This strategy has been used throughout the ages in commercial real estate, and I think this is a perfect time for it, okay? Because there are going to be companies who own a lot of real estate who need capital to be able to do some things, stay alive maybe, or just, shift how they're doing things. And as an investor, if you can identify what companies those are who own those buildings and acquire them at a good price, lease them back on a long-term basis where it's profitable for you, you will make money. I think a lot of bigger deals are going to happen in this space. However, this can be done on a smaller level as well, because again, if you're an owner and you own that space, a lot of business owners like to own their space. They like control. They don't want to be told what to do. And a lot of them, as a business owner, a lot of times you don't have a retirement plan. So a lot of people look at their corporate real estate as a way of, for the small business owner, as a way of having a retirement plan. Hey, I'm going to run my business from here 30 years from now. I'm going to pay the mortgage off, and I got a free and clear building where income's going to come in it, or I can sell it and for my retirement. So this is a way where you can help somebody achieve that goal and generate solid passive income. The key, or the advice I would say if you're going to do this, is to look for companies that are essential, because this pandemic we're in may be around for a few years. We might see another pandemic, all right? So you want to look for companies that are essential, but maybe they don't need all that space, and or maybe they do need the space, but more importantly, they need the equity, the capital that's locked into their property. And this is an excellent way for you to tap that equity for them, help them solve a problem, and get yourself into some solid, dependable, passive cash flow in a distressed market, right? Solid and dependable is important. Third way, now this is unique, okay, but this is again done through the ages, is buying performing and non-performing notes on commercial real estate from banks and lenders, okay? Let me tell you why I think this is gonna be important. Because as we go through this next, I don't want to say crash, I don't think it's going to be a crash. As we go through this next market shift, I think that's a better word for it, there's going to be some distress, right? We know that. Now, banks, we went through the Great Recession just a short 10, 12 years ago, and a lot of the banks have wised up to the sense of they don't want a bunch of REO assets on their books. They would rather do a short sale or sell the paper, so that they don't have to carry those assets on their books. Because when a bank, for instance, has to carry that asset on its books, it does a couple things to them. It lowers their overall rating as a bank, and it also restricts the amount of money that they have to lend out, because every asset that they take back, they've got to keep a certain amount of capital in reserves. That is capital that they would like to invest out into other loans. So I think that a lot of banks, when they realize that there's some distress in their portfolio, they're going to be looking to either do short sales, and they're going to be looking to sell the paper. Now, here's the deal, though. As an aspiring investor, I think you got to go after the deal. You can't just sit back and look, because there's not a real clear paper market. That's paper gets traded all the time, but it's not like you're going to find that on LoopNet. You know what I mean? You kind of got to, go after it and figure it out. Now, there's definitely some pitfalls here. And I noticed I said performing and non-performing. Performing meaning this, that the owners of the property are still paying the mortgage, right? And so when you buy a performing note, let's say the loan amount is $1 million, the bank's gonna want to sell it for par, meaning they want to get as close to that $1 million as possible, if not all of it. But there typically is always some kind of a discount. But par value, let's say, is maybe you're buying it's $1 million. Maybe you're buying that $1 million note for $980 or $975, right? It's not that big of a discount because the note's performing. But the bank's interest is saying, hey, we see troubles in the water here. Let's move this paper, take a short loss, but let's get our capital back. Get that capital back either in our coffers or back out on the streets. Okay, I think a lot of banks are going to be doing this. Now that's performing, particularly in non-performing notes. That's when the owner of the property is not making their mortgage payments, or there's some element of default in the loan. Okay, whether that be the loan is mature, or the property has now received has so much vacancy that it's outside of the loan covenants, that it's another type of a default, something to that effect. Maybe the company that owns it has filed bankruptcy. So now, even if they're paying their mortgage, that's a non-performing note. It's in default. So this is where you can make some real money, but you got to be careful. Now, when you're buying non-performing notes, you don't want to pay par value. You must get a discount, and that amount really depends on a lot of factors. So I won't get into specifically like guidance on the amount, but you need to get a discount, because here's why. If it's non-performing and you buy the note, a lot of people who do this want to take over the properties. A lot of hedge funds do this type of stuff. This is an aggressive way to buy real estate. But if you're looking just for the income, here's the deal. You're buying something where the income stream maybe stops. So you have to buy that at a discount and then maybe negotiate. Now, once you do that, now you can reach out to the borrower and say, hey, maybe we renegotiate some things to get you back on track and adjust your interest rate, we modify the loan and everything. And then they're making maybe lower payments than they were, or maybe you took their back end payments and their delinquent payments, structured them on the back end in a way where, okay, they can start back making payments and then you can make money. This actually is a great way to solve problems in the marketplace. I think we'll see, but then there's the loan to own strategy. This is aggressive, guys. This is when you buy a note at a discount for the purpose of finishing the foreclosure and taking over the property, because you know that property, but you only do this if you see that the property is really in distress. There's no way that this company can make it or this owner can make it. Their tenants are gone. The property's in distress. They're not going to be able to make it. And because then you buy it with the intentions of finishing off that foreclosure. That's very difficult to do. Okay, because they could also file bankruptcy. They could stick you in the bankruptcy for a year to 2 years, which may or may not be worth it, depending. Right. But the key, I'm talking about making passive income in this video. And I think whether the loan was performing or non-performing, you can acquire it at a discount. And I think here's a great problem-solving thing for the marketplace. Say you take a non-performing note, buy it at a discount, you get the banks, you solve their problem. Then you reach out to the borrower and say, hey, Mr. and Mrs. Borrower, look, I know you're behind. What if we took that amount, put it on the back end, we modified your note, got it back lower. That way, if we did that, can you make the payments? If they could, you just solved the major problem. You generated passive income for yourself, because remember, you bought it at a steep discount and you helped really build the economy. Just thinking that say you did that on an office building that had 20 tenants, you just saved that office building owner, and you just probably made a significant impact on those tenants right there by not having that property go through foreclosure and all the mess that happens associated with that. Okay, that is an excellent way to generate passive income. Okay, you can also loan to own strategy. It's a little bit more aggressive, but I think buying performing and non-performing notes, restructuring the terms, negotiating with the borrowers is a great way for investors and the marketplace in general to navigate our way through this distressed commercial real estate market that is coming, that is beginning now, and it's going to be here. We need creative problems. We need creative problem-solving solutions. Sorry, that was a tongue twister. But we need that in this market going forward. I'm trying to give you guys some ideas. As a bonus, I said 3 ways as a bonus. I think forming a syndication to acquire properties that have been taken back or going back or distressed, that's always a way of doing it. And I think the more you can do that with cash or equity and less debt, that's how you ride the storm out. So if you're able to put syndication together and buy a property with cash, you can ride out the storm that we may be in, because you don't have a very low debt load. And then you're going to generate income, and when things come back, you're really going to win. That's just a bonus. These are the top 3 ways I think you can generate passive income in the distressed commercial real estate market. If this is valuable to you, please subscribe to this YouTube station. Throw us a like. If you don't like it, tell me why. I want to hear from you. I want to get back some feedback from y'all. Let's figure out ways to solve problems and press forward in the coming distressed market. Peace out, y'all. Have a great day.